we have about 40% of our book in ETFs. So we introduced ETFs into portfolios quite some time ago, purely on a cost basis. When we came up with our multi-asset strategies, we these were composed as effectively fund of funds, and cost was a very major drag. So ETFs were a quick way of being able to provide that allocation. We have different clients who have different requirements. Some clients actually state they have a preference for only an active selection. So we actually do offer a number of different suites. We can offer an all active, we can offer an all passive. But our main proposition is composed of a blend of both. And I actually, it's very interesting looking at the metrics that we've run for the performance of the active funds last year. Last year was a very, very difficult year, and there are markets that we all know, such as the US, where only 22% of the European listed active managers outperform their strategic benchmark. Even the UK managers, which kind of perform fairly well, only 47 of them outperform their benchmark. So on that basis, unless a manager can consistently outperform their benchmark, I find it hard to justify their position in a portfolio versus the cost of a passive tracker. However, there are other strategies that maybe we don't like a passive strategy, and we can see that there has been a higher significance of active managers outperforming, or as a sector, for example, with credit. Do you really want to follow the issuance of the largest issuers, as opposed to an active manager who's doing fundamental credit analysis? So you're getting real credit risk. So we do pick, it depends on the asset class and the strategy, whether we have a preference for an active over passive. But cost was the ultimate driver.
I think I want to draw a distinction between ETFs that are equity related and ETFs that are fixed income related. And we consistently talk about TER and turnover and the flexibility of selling and coming back in. And what we know is that if it takes 22 years to decide if a fund manager is outperforming or not, how many years will it take before we can fully understand ETFs are actually what they promise to be? In other words, we already know what BIS is highlighting, which is that there is huge systemic risk, because the biggest providers of funds into the fixed income arena are now the ETFs as an industry. And if we have a big liquidation phase, the market is just going to disappear, which is what the active manager every day is faced with. You ring up and you want to trade a particular bond, and the market is unwilling, the next price is 10 points down. Sure, ETFs gives you diversification, and each holding is reasonably small, so you can take that punishment, but if you had to do it en bloc, en masse, you will have exactly the same situation happening to the ETFs as is happening to the active funds. So I think we need a much longer time experience before we say, yes, ETFs are delivering what they are designed to do. They are basically going to become a much, much bigger systemic risk, and by definition, systemic risk sooner or later explodes. And when it explodes, then you have the full experience to compute annualized over whatever the time period is, to actually figure out, did they really deliver what you wanted to? And then relative to the active managers, what did they do? So I think the jury is out. Just be very careful to draw conclusions on a very incomplete period.
Can I just add something on that? Because if you actually look at the last credit crunch, when actually corporate bonds became totally illiquid, and actually what happened was there was lots of corporate bond mutual funds where they had to be suspended, or they had to have huge kind of premiums. But the ETFs, the largest ETFs in fixed income, became a liquid proxy for the market. So actually the opposite is true. Last time round, when there was a liquidity crunch, the fixed income ETFs became more liquid and the mutual funds became less liquid.
There's a huge growth in fixed income ETFs. It's become an access product. It's made it much easier for people to actually invest in bonds when it was the privilege of the fewer, historically, and that's why we've seen such a huge growth, and it allows investors to now have products which segment kind of risk buckets, duration, sectors, ETF, bond sectors, etc. Having said that, I'm not sure the statement that they will, we need to see if they will do what they're supposed to do in 22 years. I think what ETFs say they're going to do is that they will follow the index with very low tracking error and very low fees. What ETFs don't say is that in a case of crisis, you know, we will make the market more liquid for you. It is a tool, and in that scenario, I think the ETFs are doing what they're doing, and possibly are giving an alternative source of liquidity, as Alan was saying, in such a crisis situation.
Your competitor State Street has lowered the fees on 41 ETF funds from its range to 35 basis points from 50 basis points. Will you be following suit? Is this a start of the next round of the ETF price war?
I wouldn't call it a price war. I think certainly from an Amundi perspective, from when we set out 6 years ago, you know, we've always said our aim is to be 25% cheaper than the market. So that is one of the key tenets of how we build our business, which is to be cost effective. The other one is innovation, you know, quality tracking, etc. But in terms of, you know, from our point of view, we do have our finger on the pulse. I think it is a good thing for everybody. It improves adoption, and I think as an industry, if we become more cost effective, the uses of the ETFs become wider. So, for example, if the TERs were still at the rates that they were 5-6 years ago, we wouldn't be effectively competing maybe versus other instruments like futures at this moment in time.
Delyth Richards, you mentioned the cost being a key criteria in selection terms. Are the cheapest funds always a shoe-in to your portfolios?
We also look at the tracking error. So it's not just a function of cost, it's got to be tracking error and cost together. So we're looking for the lowest tracking error at the most efficient price. So in some instances, no, we might not take the cheapest ETF or ETP on offer because we're not satisfied with its tracking error. That's a simple answer.
I think that cost is important, but I don't think cost is really the biggest concern. It's all about performance. So at a much higher level, I think it's asset allocation. If you get the asset allocation right, you'll have good performance. If you get it wrong, it's very hard to have good performance. Then you come down to this fight between the passive and the active managers, and I don't think there's a binary outcome. I don't think you can say one is right or one is wrong. The more efficient the market, the harder it is for an active manager to outperform that index. So therefore you might want to build a core portfolio with exchange traded funds that give you a very close tracking to an index, very low cost and beta. But there aren't all parts of the portfolio that can be followed by an ETF. So you might create a satellite range around that core holding, maybe tracking property, maybe investing in emerging markets. You need an active manager to select those assets and be, you know, very good at working out where the value is. So it's not a fight between the two that ends up with just ETFs, even though the ETF market is growing by about 22% a year compound annual growth rate. It's a differentiation between the two parts, the core portfolio and the satellite portfolio. I think if you put the two together, then you get the best performance, having got your asset allocation right.